Every generation has its myths. Some worship Bitcoin, some still think Cathie Woods is early, but the quiet truth that I'm going to talk about in this video that's behind closed family office doors, diversification, it's dead. While most of us ride the S&P 500 like it's Space Mountain with no seatbelt, the rich, they're somewhere else entirely. Their portfolios aren't trying to win, they're trying not to lose. At least not the same time as everyone else. What even is non-correlation? That's what I'm going to talk about in this video. Imagine your assets are at a party. Most are crowding the DJ booth, your equities, bonds, crypto, all moving in sync to Jerome Powell's beats. But there's one guy outside on the balcony, smoking a cigar, completely unbothered by the vibes inside. That's your uncorrelated asset. When things are going bad, and they always will go bad eventually, you want to own that guy. Non-correlation doesn't mean an asset always performs well. It means it behaves differently, and in a world addicted to everything moving together, different is priceless for the rich. Risk isn't just about losing money, it's about losing control. Uncorrelated assets reduce dependency on market cycles. If stocks tank, you don't have to call your tax guy and say, hey, remember that Roth IRA? We need to talk. Let's be real, when you're ultra wealthy, your job isn't to double your portfolio. It's to never take a drawdown that forces you to change your lifestyle. Owning low beta, low correlation assets becomes your insurance policy against being the next cautionary tale. Take the 2008 financial crisis, for example. Equity-heavy portfolios dropped 40 to 50%. Certain managed future funds like AQR Managed Futures Strategy Fund, it actually gained a positive return. Those who held a meaningful allocation to these strategies had portfolios that didn't just survive, but they recovered faster and rebalanced into strength. Here are 5 uncorrelated favorites of the ultra-wealthy, each one with a real-world play. Farmland, for example. Bill Gates is now the largest private owner of farmland in the US. Why? It produces income, appreciates, and is resilient to inflation. In the 2008 financial crisis, Midwest farming rose in value while nearly every other asset fell. Or private lending, for example. Institutions like Blackstone run massive private credit operations. This is when they lend to middle market businesses that banks overlook. In the low-yield world of the 2010s, private credit quietly became a multi-trillion-dollar industry. And some commodities like timberland are loved by the rich. The Harvard Endowment once owned hundreds of thousands of acres of timberland across the globe. Trees grew regardless of what the Fed does. Timberland provides both yield and appreciation. I'm sure you guys have seen recently catastrophe bonds. These bonds offer high yield but only default in rare events like hurricanes or earthquakes. During the 2008 crash, many cat bonds held steady or even gained because they were totally unlinked to subprime mortgages. The most fun example to me, and the one that I like the most, is music royalties. Companies like Primary Wave have bought up catalogs from artists like Taylor Swift and Bob Dylan. In 2020, when touring stopped and stock markets crashed, these funds still paid out royalties from streaming and radio and even increased their returns. One of the most important factors that I found really interesting when researching non-correlated returns was how the rich loves having emotional diversification. The hidden alpha, you could say. There's a Sharpe ratio, and then there's the I don't panic at 2 a.m. ratio. Because they're not trading equities, they don't have the panic button, which doesn't allow them to sell whenever they feel like it. Owning uncorrelated assets doesn't just smooth your return, it smooths your brainwaves. During COVID's initial sell-off in March 2020, some investors saw 30% drawdowns in days. Meanwhile, those holding farmland REITs, they saw less volatility and in some cases, positive returns. That emotional buffer means you don't sell low or spiral. I love studying behavioral finance, and it proves that we're not built for turbulence. We overreact, and non-correlation can be your emotional shock absorber. I'm going to give you guys an example I came up. Bob versus Linda. Bob is a regular investor. He owns index funds, refreshes his portfolio daily, and thinks diversification means owning both Tesla and Apple. Linda owns farmland, music royalties, and private lending funds. She forgot her password 2 years ago. She's doing fine. In March 2020, Bob panicked, sold his tech-heavy portfolio, and Linda's allocation, it's a mix of Fundrise, private equity real estate, KKR credit fund, and a slice of song royalties. Who do you think is going to do better in this situation? In this situation, her returns dipped slightly, but her income continued. She rebalanced in April, and Bob, he re-entered in June after missing the bounce. Linda's not a genius, she's just unbothered. Her assets didn't flinch, so she didn't either. I think a big takeaway you guys should try and take from this video is that checking your portfolio is going to do you only harm. If you're not in it for short-term trading, you should try and just stay away from checking your portfolio and let it ride for years. Next, I'm going to talk about Yale and the endowment model. David Swenson's Yale endowment strategy changed the game. 20% domestic equity, 30% private equity, 20% hedge funds, and 15% in real assets. This wasn't theory, it was execution, and from 1990 to 2020, Yale's endowment fund returned an average of 11% annually. Most pension funds were only closer to 6 to 7%, so he clearly had a great strategy worked out. During the dot-com bust, Yale lost less than 5%. Why? Because they had minimal exposure to public tech equities. During 2008, they had private market write-downs, but timber, real estate, and hedge fund allocations softened the blow. The Yale model proved that you could outperform and de-risk at the same time if you're willing to ditch the 20/40 gospel. So you're probably asking yourself and me, can you actually do this? Surprisingly, yes you can. You don't need to be an Ivy League endowment to build a smarter portfolio. You can start with a couple of tools. To start off, REITs. Some stocks you could look at are Farmland Partners, ticker FPI, Gladstone Land, ticker LAND, or timber ETFs like Wood. One of the easiest ways to dip your toes into tail risk hedging is through this ETF, PFIX. It stands for Simplify Interest Rate Hedge ETF. It's basically a way to bet on interest rates spiking, or at least protect yourself if they do. During 2020, when rates went vertical, PFIX returned over 70%, while most bond funds got crushed. Why does this matter for you? It's an example of a liquid, retail-accessible hedge that actually paid off in a real-world macro event. You don't need to be Bridgewater to buy protection anymore. PFIX is the kind of tool that adds real diversification both statistically and emotionally. The last example I'm going to dive really quickly into is fractional ownership. For example, you could look at Masterwork, which helps you buy fractional ownership in art, AcreTrader for land, or Royalty Exchange for music. The key I want you guys to get is it's combining these into your core investing portfolio, not replacing it entirely. Even though non-correlation is great, it doesn't mean there's no risk. Let's be clear, uncorrelated doesn't mean it's safe. Each asset still does have its own risk profile. For example, farmland could suffer from droughts or zoning laws, private credit could have a credit and liquidity risk, and cat bonds could default from major disasters like Hurricane Sandy. But the most important part to keep in mind is that when those risks happen, they don't coincide with equity crashes. That's the real power here. When the S&P drops 30%, your farmland won't. An investment will never have zero risk, but you can definitely avoid concentration risk by spreading exposure across risk types, not just sectors. Uncorrelated assets often bring something else, convexity, that magic quality where you gain more in chaos than you lose in calm. I'm sure people that have taken economics or majored in economics know what convexity is, but for those who don't, it's a measure of the curvature and the relationship between bond prices and interest rates. It shows how a bond's duration changes as yields change. To dumb it down for you guys, convexity tells us how much the price of a bond will change when interest rates go up or down, kind of like how a curve changes shape when you bend it more or less. The rich have a much different philosophy than the lower class. The poor chase returns and the rich manage exposure. They don't ask what's the best stock of the year, they ask what will protect me when everything else falls apart. For example, one of the best investors of all time, Ray Dalio, his all-weather portfolio, it's not a return maximizing structure, it's a drawdown minimizing machine. During 2008, it dropped about 3%, that's it, because it was built with uncorrelated building blocks. Uncorrelated assets don't moon, they protect. And when you protect long enough, you get compounding, and compounding makes you rich quietly. I found some historical examples I think you guys would think are interesting. In 2008, hedge funds like Renaissance Technology managed future funds that posted positive returns while global markets collapsed. 2011, the U.S. credit rating downgrade triggered equity volatility, but cat bonds, art funds, and farmland didn't move. 2022, a recent example, equities and bonds both fell. It was a nightmare for the 60-40, but commodity strategies, farmland REITs, and floating rate private credit thrived. Non-correlation isn't a trick, it's what worked while others stared at red candles. What most investors get wrong is that most investors diversify by quantity, not correlation. They buy more stocks and call it a strategy. But if all your assets move the same way, you don't have a diversified portfolio, you have one big bet in a trench coat. Smart investors focus on behavioral diversity, how assets interact, not how they perform in isolation. The next time someone says, I'm diversified, ask them, how did your portfolio do in March 2020 or 2022? If they flinched, they probably weren't diversified, they were exposed. Thanks for watching this video, guys. This is my first video, so I'd really appreciate any advice you guys have in the comments. If you like this video, hit that button. If you don't, short it. Comment your weirdest asset class you can find, and bonus points if it's legal. I got some new video ideas I'm going to share later this week, so make sure you subscribe for more episodes where I'm going to talk about decoding hedge fund strategies, retail trading habits, and teach you guys how to survive the markets emotionally, statistically, and sarcastically. See you in the next one.